Where are you going to put your money? Big tech is not like the compelling new thing, it's the understood thing. My strategy as a tech investor, Brian, is you buy something that everybody in the world needs, nobody can stop, and 99% of the world doesn't understand.
And you have also become probably the most famous Bitcoin evangelist in the world in the process and been embraced by the community. What's that been like for you? Because that's a transformation.
If you wanted to give education and erudition to 5 billion people, you can't do it with MIT and Harvard and libraries and books and teachers and professors. You need to do it with digital books and digital education. You need YouTube and iBooks, and that's why Google and that's why Apple are exploding in value. If you want to give wealth to 5 billion people, Brian, you can't do it with gold. You can't do it with land. You can't do it with buildings. And you can't do it with 20th century stocks. You can't do it with collectibles and art. You can't do it with diamonds. Those are 20th century property. You can give 10% of the people wealth that way. You can give 10 or 20% of the people wealth with banks and stock exchanges. If you want to give 5 billion people wealth, you need to give them digital property. You need to give them digital gold on an open monetary protocol running on a $50 Android phone. And that's why I say often Bitcoin is hope.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go?
This is London Real. I am Brian Rose. My guest today is...
This is London Real. I am Brian Rose. My guest today is Michael Saylor, the American entrepreneur, technologist, author, business executive, and Bitcoin evangelist. You are the CEO and chairman of the business intelligence company MicroStrategy, which you co-founded in 1989, a few years after graduating with a double major from MIT. You're the author of the New York Times bestselling book, The Mobile Wave, How Mobile Intelligence Will Change Everything, which correctly predicted the sharp rise of technology giants Amazon, Apple, Facebook, and Google, while highlighting the impact of mobile and social networks on global economic development. You have described Bitcoin as the apex property of the human race. And last year, you began a massive investment drive that has seen MicroStrategy purchase over 100,000 Bitcoin, worth over $3 billion today. Michael, welcome to London Real.
Thanks for having me, Brian.
Great to have you here. Before we get started, I got to ask you a couple questions about MIT. I got there in '89, so I missed you by a couple years, but it's a very special place. And I still remember walking through that front door of Lobby 7 and looking up at the dome. And even though I was this punk kid, I still somehow felt honored to be there. And I think it changed me in so many ways. Some I don't think I'll ever really understand. I also had a fraternity experience there, which was a really important of my evolution as well as kind of like a man. Just curious what the experience was like for you and what it was like as an 18-year-old kid from Ohio going to Boston, Cambridge, and going to a place like MIT.
Well, it was definitely a very, very, maybe the most important formative experience of my life. If I think about the impact it had on me, when I graduated from high school, I was the valedictorian. When I got to MIT, I was one of 400 valedictorians. Every single person at MIT was the biggest overachiever in their various community. And so it was interesting to be surrounded by so many overachievers. Also, I came from a middle-class family in a public school, and I came in contact with a lot of children from upper-class families and private schools, and they had 2 years of calculus, or they had 2 years, 1 to 2 years of college education before they showed up, and we were just going to college, So I saw people from every class. I think out of my 9 fraternity brothers, there were like 6 or 7 Eagle Scouts. It got to be kind of silly. And then I saw people from everywhere in the world, right? So MIT brought together global elite overachievers. That was interesting. I think the other thing that was interesting was MIT had this ethos of do it yourself, think for yourself, and be fearless. So, they would give you a very difficult problem, and they expect you to solve the problem from first principles, and they gave you the tools to do it. I think the third thing I saw was I had some of the most brilliant fraternity brothers. They're the kind of guys that, 18-year-old, 19-year-olds, and they're the kind of guys that get bored in the summer. They take the car apart, put it back together again. One of them took cars apart for a living and put it back together again. The other one had launched a computer software gaming company, while he was in high school, and launched a Pac-Man knockoff, successful enough to get a cease and desist letter from Atari. And so you just saw all these examples of excellence, and it gave you a lot of confidence. I think that's what I took from MIT, confidence.
And that fraternity experience, how can you describe that to someone? Because I think it's so often misunderstood. I bet it doesn't even necessarily exist anymore the way we knew it. But for me, it was so important. I spent 4 years living in my fraternity. I never lived in any other public housing. I grew up, like you said, with people from all over the world, different classes. There were the guys that couldn't afford pizza and the guys that could afford pizza. That was like the divide. But what was that? Because I know you co-founded MicroStrategy with one of your fraternity brothers. So what was that like?
It was, if you dumped a bunch of brilliant Eagle Scouts together into a house between the age of 18 and 22, and they all spontaneously organized a government, then that's what a government, an ecosystem, and a culture. That's what I saw at MIT. It's in retrospect, it's quite amazing. We ran our own finances. We ran our own work week where we would maintain the house. We had sophisticated everything. We had elections. We had a CFO. We had a head of maintenance. We had a social chairman, and we orchestrated the most elaborate social events, the most elaborate construction development events, fundraising events, about Rush Week and all those events, trips. And you kind of took for granted that a 20-year-old could run an elaborate enterprise, with due process. We had parliamentary procedure, we had house meetings, we had votes, we had all manner of intricacies. So it was a microcosm of the world run by a bunch of people that were 12 to 36 months out of high school. And, looking at it today, so many people expect, big institutions to do everything for them, but we were completely self-reliant at the time.
Yeah, I'm having flashbacks. There were 50 of us at 233 Mass Ave, average age 20, maximum age 22 or 23. Like we had to feed ourselves, clean ourselves, social chair, everything, and then have a pledge class. So you had to go through that whole thing and put them through the process of becoming brothers. And we figured it out somehow. If my wife could see some of the meals we served, she would be shocked. Or some of the look of the kitchen on some days, or the sticky carpets after a party. But there was something beautiful about it as well, because we just got on with it, and it did function somehow. So some good memories flashing back here. And again, those lessons you say about MIT, it's funny because they don't tell you those things, but it's just this ethos of the place of, here's the fire hose, stick it in your mouth, figure it out. You will figure it out. We're not going to tell you how, but we're going to kind of imply that you can do it. And so go. And I remember that too. So really, really brilliant memories. Look, I want to talk to you about Bitcoin today. I want to briefly tell you when I first heard about Bitcoin because it involves a friend of yours. In 2013, I was doing my show London Real after I quit my job in banking. I couldn't take it anymore. And I had heard about this thing called Bitcoin, and I put out on Twitter, who's the one that can tell me about this instrument? And this one name came up in London, and it was Max Kaiser. And so after a couple tweets back and forth, as we called each other out and sized each other up, Max showed up in my kitchen here in Shoreditch. And I didn't know if we were going to have a fight or what. And we had a broadcast. And for 90 minutes, Max schooled me on Bitcoin. And I think I just bought two for 85 pounds. I was complaining. There was no market makers, the order book system. And Max really laid it out. And that was my first really experience with it. And that episode's still up. It's fascinating to watch now. And then I didn't know what to do with it. And so in 2015, 17, and 19, Andreas Antonopoulos came back and would always tell us about what was happening and what it could be in the future of money. But again, it didn't hook me. And it wasn't until this year when I started looking at what was going on in DeFi that I got reminded about what I was doing on Wall Street in the 90s. And I thought, wow, this is crazy because I used to do this 30 years ago and now other people are. And we can talk about that stuff later. Tell me about your experience with Bitcoin, because I know you knew of it back in 2013, but I think it wasn't until last year where you really saw it.
You know, in my professional life, I've run MicroStrategy, which is an enterprise software company, for 30 years, and I'm a public company CEO. And most of my mental energy was consumed by competing against Oracle and IBM and Microsoft and SAP and selling enterprise software to everybody on earth. Part of what I did was run a treasury, and our treasury at MicroStrategy primarily consisted of a very conservative, conventional corporate strategy of hold cash and short-dated sovereign debt. And that's what I did for a long time. And occasionally we would take that treasury cash, we'd buy our own stock back. But we didn't pursue any other investment agenda with it. In my private life, as I was a private investor, and there I was a tech investor. I bought Apple, I bought Amazon, I bought Facebook, I bought Google. I wrote about why I bought those things in the mobile wave. But the summary is the best investment ideas of the century, I believe, are you buy into a digital network that is dematerializing a product or a service, or some kind of idea in a civilization, and you wait. Right? Facebook dematerialized friendship. And Apple dematerialized everything you could hold in your hand. It dematerialized wallets and cameras and photos. And Google dematerialized information and books and video. And Amazon dematerialized storefronts. And so those digital networks that dematerialize things, they grew through the web era. And we know that story. And then when the mobile era came along, all that software mobilized, and pretty soon you had a store in your hand called Amazon, and you had a library in your hand called iBooks, and you had friendship and relationships in your hand called Facebook, and you had a camera in your hand, and probably every other mobile device, a tape recorder, the like, and Apple, and I kind of rode that wave for a decade. And in 2020, I knew Bitcoin was around. I knew some people use Bitcoin for something or other. I also, thought it was kind of cool that you could go on markets and bet on who was going to win an election, if you remember that. And I thought online poker was cool, and I thought there were a lot of things that were cool, but I classified them as novelties. I classified Apple, Amazon, Facebook, Google as good investments based on a digital network. And my professional approach was I invest in short-dated treasuries. Then March 2020 hit. The money supply started expanding at 3 times the normal rate. We had lockdowns which shut down Main Street. And we had a V-shaped recovery in Wall Street. And so between March and June, as I watched Wall Street recover, and if you look at the S&P index and the stock market for the past 12 months, it's just straight up and to the right. It's like there is no crisis.
Yeah.
And if you're living on Main Street, Main Street hasn't recovered. I mean, the cruise lines aren't up and running. The airlines have been impaired. The hotels are impaired. Lots of manufacturing business are struggling. There's rampant problems in getting labor. There's rampant supply chain issues, and there's shortages. And so that dichotomy between the recovery of Wall Street and the impairment of Main Street caused me to question my premises about money. I started by questioning my premises about Treasury policy. Brian, I had $550 million in cash, and it was yielding 0% interest. And when the Fed said, we're not even thinking about raising interest rates, the message was, for the next 4 years, you'll get 0% interest on $500 million and you'll like it. Then I started thinking, then I watched Wall Street recover, and if the S&P, if we actually look at S&P performance over the last 12 months, it's up 37%, Brian. And so if you had $1 billion and you held it in cash, you're up 0%. And if you held it in S&P index, you're up 37%. If you took the same $1 billion of cash and you bought gold, you're up minus 72 basis points. That is, you're up 0%. If you invested in Bitcoin, you're up 269%. So what is the message, right, that the world's trying to tell you? It's that we expanded the money supply. If your long-term saving strategy is put your money in a bank account as dollars or euros, then your money lost, call it 37% of its purchasing power, right? If you put your money into an ETF or S&P index, your money held its purchasing power. If you put your money into Bitcoin, it gained purchasing power. And so as a corporate fiduciary, I got $500 million. What am I going to do? Well, I don't want to hold it in cash when I know that the currency is being devalued and the interest rate is 0. That's a negative real yield. If you calculate negative real yield based on CPI, you might say to yourself, oh, it's only minus 2% negative real yield, or the CPI now is like 5%, minus 5% negative real yield. But if you calculate inflation based upon asset inflation, the asset inflation rate for a portfolio of companies is 37%. So your negative real yield is minus 37%. And the rule of 72 tells you that you lose half your money in 2 years at that rate.
Wow.
You lose 90% of your money in 10 years. So when the negative real yield got to minus 37%, Brian, it's kind of like you crank the temperature up in my hot tub to 250 degrees, and I jumped out. So how did I discover Bitcoin? The answer is, it wasn't a problem for me until March of 2020. It was an opportunity, but I had other opportunities, and it wasn't a clear enough opportunity that I would change my life in order to go do this thing. But in March of 2020, the big tech trade came to its end. Amazon was, $3,200 a share. Well, I rode it from $300 a share to $3,200 a share. It wasn't going to go up by a factor of 10 or 20 from there. Apple, Amazon, Facebook, and Google were acknowledged digital monopolies and dominant networks, and every 22-year-old taxi cab driver could have told you that those were the winners by March to June of 2020. So where are you going to put your money? You can't, big tech is not like the compelling new thing, it's the understood thing. My strategy as a tech investor, Brian, is you buy something that everybody in the world needs, nobody can stop, and 99% of the world doesn't understand. And that would be the definition of Facebook in 2011 or 2012 or Google or Amazon. You could, if you go back to 2010, you could see Apple, Amazon, Facebook, Google are unstoppable. Everybody needs them. And yet 98% of the people on Wall Street would have told you when Apple doubles, you should sell some, take off the top, and you should diversify into HP and IBM and other. And when technology is more than 20% of your portfolio, you should sell technology and you should diversify into non-technology. So the diversification in that case is selling the winner to buy the losers. And of course, the idiocy is Apple became 150% of the profit of every mobile phone company in the world. Everybody else in the world lost money to compete with Apple, which made all the money. Okay, that's why you don't diversify from the category killer. Amazon won, Walmart stayed, was like a number two, and every other retailer in the world lost in that decade time frame. So selling the winner to buy the losers within the sector doesn't make any sense. And there's a certain arrogance and foolishness from a Wall Street investor that says you have too much tech exposure. You went to MIT, I went to MIT. What I observed is every growth company in the history of the world, going back to the Carthaginians versus the Romans, they were all tech companies. When the Romans beat the Carthaginians, they did it with technology. When Kraft and Heinz and Standard Oil and Carnegie Steel and Andrew Mellon, and the Aluminum Company of America, when they won, they were technology companies. AT&T, General Electric were technology companies. General Motors was a technology company. There was never such thing as an entrepreneur that took a small thing and made it into a huge thing without technology. So it's only the third generation of investors that have forgotten how the company was built, that think it's a non-technology company. So bottom line, when something is no longer, disrupting the world, its growth slows down, it becomes a monopoly. When I got to March, April of 2020, what I said was the big tech trade is a crowded trade, and holding cash is a foolish idea. Sovereign debt is no longer a store of value. Bonds are broken. We're at the end of a credit cycle. My stock was $90 a share. I had $60 a share in cash, Brian. So I had the entire company was worth $30 a share, and the investors, when I asked them, said, "Cash is trash, right? Give it back to us." And so I hit this existential crisis. I had to go study. I had a problem. I needed a solution, and we were going to take one of two paths. We either had to give back all the capital, and we would have had $30 to $60 a share worth of the stock in a company with no capital base that was growing 0% a year, competing against Amazon, Facebook, Apple, and Google. Good luck with that. Or we had to invest the money in something which was going to hold value or accrete value in a monetary inflation environment. And so we did a search. We considered gold. We considered tech stocks. I already described where I thought tech stock was a crowded trade. It was already done. Buying gold was a good idea in the 19th century. In the 20th century, it's too slow. In the 21st century, it's looking antiquated. Well, I said, I want something like gold, but I want digital gold on a big tech network. What if I could take $1 billion of gold, that weighs 30,000 pounds? What if I could take that, dematerialize that gold so it moves at the speed of light, it weighs nothing? What if I wrapped it with an open protocol so I could program it? And what if I could program my iPhone or my web server to do 1 million transactions a second on the block of digital gold, move it at the speed of light, and make it brilliant, smart. And then I plugged Moore's law into it, and it just kept getting smarter and faster and stronger. Well, the secret to everything that worked in the last 20 years, Google, smarter, faster, stronger. Google Maps, it knows which way the traffic goes. It knows it's a traffic jam. It routes you around the traffic jam. It'll talk to you. It'll nearly drive your car for you. It's a better idea than Rand McNally Maps. That's why Rand McNally is worth 50 million or 500 million, and Google's worth 50 billion with Google Maps, right? That one thing. Your iPhone, smarter, faster, stronger. iBooks, smarter, faster, stronger. Apple Music, smarter, faster, stronger. So I thought, give me a block of dematerialized gold on a big tech network that's smarter, faster, stronger. Where do I find that? Crypto. Crypto created digital gold, and Bitcoin is, in essence, digital gold on a big tech network. But now it checked all my criteria. It's something everybody in the world needs, nobody can stop, and nobody understands. In March of 2020, you could say, you got there early. Max Kaiser will tell you, yeah, you should have figured it out back in 2013. But the point is, by 2020, it was a $200 billion thing. 99% of the world doesn't really understand it. How do you understand digital property on an open monetary protocol that's decentralized when there is no metaphor, there is no analogy to it in the last 5,000 years? A new thing. Nobody understood it. Everybody needs it, right? It's decentralized. Nobody's going to stop it, right? They might slow it down, they might FUD it, but that was the beautiful triple check criteria. And I said, I have a $500 million problem. I think I'm going to buy me some. So that's how I discovered Bitcoin. And that's why it became the most important thing in my world in the second quarter of 2020.
Did that process take you days or weeks until was your brain was it a 3-day thing where you were like, you're getting excited about it, and all of a sudden you're like, I know this is the right way? Or was it weeks before you knew this was what you were
the
going to do?
first 5 or 6 times people mentioned it to me, I just dismissed it as like a risky, complicated, cool. I knew it was cool. I knew it was a cool thing, a decentralized network. I knew other people were passionate about it. I didn't have the problem. You kept tugging on my coat, but I didn't have the problem. I'm like, go away. I'm making a lot of money on my Amazon stock. I'm making a lot of money on Apple. I have a problem in my business. Before, if you had asked me, do you want to meet via Zoom in February of 2020? I was like, what is Zoom? If you said, can I work from home? No, you're fired. What about remote work? No. You come into the office, we meet face to face. If you'd asked me the same question in April, I would have said, well, of course we use Zoom. We're standardized on it. We all work remote. We went from 10 million people on Zoom to 400 million people on Zoom in 4 weeks or something. The world accelerated its digital transformation of sales, of marketing, etc. If I had gone into my board of directors in February and said, I think we should buy 500 million worth of Bitcoin, they would have said, what is Bitcoin? You're out of your mind. You're crazy. It took, this is the history of science is the history of paradigm shift. And the one thing you learn when you study the history of science is paradigm shifts come two ways. Either the old guard dies, everybody dies, and the new generation picks up the thing, or there's a war, and you're going to die if you don't actually learn a new thing. And so in the midst of a life or death war situation, then people have their minds open up and they embrace a new idea, right? That's the history, that I could go through 5,000 years of history. I could tell you people that had paradigm shifts driven by war or driven by the death of the old guard. We had a war on COVID, and we had a war on currency. The war on COVID locked down the entire world, and the currency war, the response of the policymakers was literally to declare war on the currency. The US currency has been devalued by depending upon your metric, 20 to 35% in the last 12 months. But currency in other places, Argentina's got 85% inflation. The currency in Venezuela, they're collapsing 60, 70, 80%, right? And so what you have is a devaluation of currency. The war on currency means we're squeezing all the economic energy out of the currency, right? And where does it go? Well, it goes into bonds, and then everybody that held bonds as a store of value sells their bonds, and they move their money into equities and into real estate. And so you're seeing monetary energy surging from the currency to the bonds, to the equity, to the real estate, to collectibles, to cryptocurrencies, to meme stocks, right? That was the war. So how long did it take me to figure it out? Well, after March, I mean, the first thing we do is we deal with the lockdowns, and you've got an immediate issue at hand. You've got thousands and thousands of employees and customers you got to take care of. And how do you rewire the business in a world where the office is closed and you're operating remotely? That took us a lot of Q2. And at the same time, as I'm studying my operational problem, and I'm basically doing a digital transformation of a 2,000 person software company, I actually start thinking about the transformation, in this case, the digital transformation of my balance sheet. And I would say, it takes 10 hours of study to start to get an inkling of what's going on. It takes 100 hours to start to be reasonably versed in what's happening here. And it takes 1,000 hours for a reasonable person to have a fair grasp of everything. If you want to be the ultimate master, you need 10,000 hours. Before you're comfortable laying on $1 billion position, you probably ought to have 1,000 hours. Before I convince you to risk huge amounts of money, you probably need 100 hours. And before you can ask me an intelligent question, you need 10 hours. So that's the path that we went down.
Was it hard to sell to your board? Were you concerned because you were a public company? And then did you expect more CEOs to follow? I know you talked Elon into it, and we can get into that, but were those other two issues, and did you have some trepidation when you went in?
We had a lot of trepidation. I mean, there was a lot of trepidation in the year 2020 for a lot of people, right? In every single business, across every dimension and every aspect of life. And we're still working through those issues today. We will be for probably, a number of years to come. The process was first me educating myself. So I went through those Andreas Antonopoulos videos. I read The Internet of Money. Then I read the Bitcoin Standard. Then I started, binge watching every other Bitcoin podcast, cryptocurrency analysis, starting, reading the bullish case for Bitcoin, reading, every essay I could find on the internet. You can learn a lot on the internet. You can learn a lot on YouTube. I figured out pretty quickly I could speed everything up to 150% and speed listen while I'm, so you're speed listening while you're eating dinner and you're absorbing a lot. Once you do that, you realize that you don't want to go back to like taking a 1 or 2 hour lecture a week over the course of a semester. Just like people binge watch Netflix, television series in a weekend. You start binge watching 30 hours of podcast at 150% speed with a little bit of skipping, and you find that in 10 hours you can cover a semester of content. So I did a lot of that. Once I got myself comfortable, then I put together a summary of materials, like 4 hours of videos and 10 documents or something like that I sent to all the officers and directors of my company. Then I started meeting with them individually. Then we started having group meetings. We got educated. Then we split up, and then the general counsel went off to do the legal review with our outside counsel and to retain other counsel. The CFO went off to do the accounting and the finance review with outside auditors and finance experts, and the board did their research. And then we came to a very elaborate process, Brian. We couldn't just buy 500 million of Bitcoin and put out a press release. We're a publicly traded company. So the first thing we do is we have a deliberation, and the conclusion is we're going to actually buy $250 million worth of something, and we're going to buy back $250 million worth of our stock. So the first press release and the first announcement is we've decided that we're going to invest $250 million of our capital in a treasury asset or a mixture of treasury assets. This may include stocks, bonds, real estate, gold, silver, Bitcoin, or cryptocurrencies, something like that. We let the market think about that. We also said we're going to buy back $250 million worth of our own stock over the next 12 months. We announced a share buyback program. Stock is $120 a share. $60 a share, and put that in perspective. It's a $500 million company with $600 million in value to the enterprise and $600 million in value to the cash. About 1.2 times revenue. At that point, we had concluded, we were going to generate a lot of cash flow, $70 to $90 million in cash flow a year. I mean, the digital transformation of the operation meant we weren't going to need capital to grow the business. We were going to generate a lot of capital because the things that were expensive, like throwing trade shows and flying around on airplanes and staying in hotels and spending money on all this advertising, that just all went away. So we knew we were going to generate cash. We knew we didn't need the cash. We announced this generally to the public. Crickets. Stock trades 20,000 shares a day. Nobody really notices. They don't care. 1 week later, we went to stage 2, where we said, okay, well, we've gone through our analysis. We've decided to buy 250 million worth of Bitcoin. We did it. Here's the announcement. And we're also announcing a Dutch tender offer. We're going to buy back $250 million worth of our stock in 20 days, and you can tender your shares for up to $140 a share. So in essence, the message is, if you don't like the Bitcoin strategy, this is your chance to get off the roller coaster, and you can get off with profit. You can sell your shares back to us at $140 a share. Stock's trading 121, 122 when we announced that. You got 20 days to think about it. So the idea is, don't surprise anybody. I don't want to tell you, figure out what Bitcoin is, and you got 5 minutes, right? That creates anxiety. You can't figure out in 5 minutes. The company has embarked on a novel new balance sheet strategy, and we're going to give you 20 days to figure out whether you're going to buy more, sell, or hold your current position. And should you decide you want out, the company's going to backstop you. We're going to buy the first $250 million worth of stock at a premium. So the market trades. First, it trades into the 130s. Then they think about it a bit. Then it trades up past 140 and maybe past 150. Okay. So you've got kind of a put, you can put the stock back to the company at 140. You would think it would trade at least to 140. For 20 days, the shareholder base rotates. We want them to rotate. If you hate it, we want you to sell. If you love it, we want you to buy. At the end of the tender period, we don't know what's going to happen. We could have had $250 million tendered. We could have had none tendered. We had about $60 million worth of shares tendered. Okay, so we buy back $60 million worth of shares at $140 a share. Then we have $175 million of extra cash. We think about it. We have a board meeting. We adopt Bitcoin as our treasury reserve strategy, our treasury reserve asset. So the next message to the market is, MicroStrategy is adopting Bitcoin as a treasury reserve asset. If we have excess capital, from time to time, we're going to convert it into Bitcoin. Let the market think about that. Shortly thereafter, we bought 175 million worth of more Bitcoin. Now we bought 425 million worth of Bitcoin. Well, the people that are shareholder bases, you either are you long Bitcoin or are you short Bitcoin or are you a neutral to Bitcoin? We don't have to convince everybody. We just have to be transparent with a group of people that happen to like Bitcoin. So, and maybe you could say, I just got to convince anybody, right? It's like, I'm not trying to convince 100% of the people that they should love Bitcoin. I'm just trying to find the 1% that like Bitcoin and then act with transparency and integrity and offer them a publicly traded company where they can invest in such a strategy. So at that point, we had 425 million worth of Bitcoin. We started to communicate why we did it. We thought it's digital gold. It's smarter, faster, stronger than traditional gold. And it offers a monetary inflation hedge. The world starts to digest that. Our stock trades up. Bitcoin trades up. At some point, our stock trades up to 200. Then it trades up to 250. Then people discover maybe this is a good idea to own Bitcoin. We buy the Bitcoin at the first thing we bought, it was like 11,800. People are like, you're crazy. You're taking all this risk. It traded down to 10,000. We bought some more. They thought you're double crazy. We took the risk. I'm like, I don't think I'm crazy. I think I'm, well, what are you going to do if it trades up or down? And the answer is, I'm not a speculator. I'm not a trader. I don't care whether it trades up or down. I'm holding it they're like, well, how am I going to hold it? Well, forever. I'm holding it forever. It's property. I mean, a decade you want a time frame, a decade we can market. I mean, short time frame is 4 years to figure out whether it worked out in the short time frame. Mid time frame is a decade. Reasonable time frame is 100 years. That's why we bought it. People thought that was kind of crazy. Like, are you speculating? No, I'm not speculating. Okay, it takes a while. People don't, they don't quite figure it out. At some point, our stock traded up. Well, all of a sudden our stock trades up to a 10-year high. We keep making money. Our employees exercise some stock options. We make more money. We have more cash. We go buy $50 million worth more Bitcoin. I think we buy another 75 million worth of Bitcoin. Now we bought 500 million worth of Bitcoin. Bitcoin doubles. We've made $500 million. The stock has doubled. At that point, the stock gets to $300 a share. It's more than it's best in a decade. We go to the market and we offer to sell $400 million of a convert bond. The market loves the idea of a convert bond. Okay, here's the idea. We're going to basically raise $400 million. We're going to buy Bitcoin with it. If Bitcoin goes down, you still got the bond. If Bitcoin goes up, you've got the upside of Bitcoin. Where else can I buy a Bitcoin bond that makes me money if Bitcoin goes up and doesn't lose me money if Bitcoin goes down? I've got a software company standing behind it. Okay, people wanted to buy that bond. We were like quadruple oversubscribed, so we raised the bond from 400 million to 650 million. We paid 75 basis points in interest. We borrowed $650 million at less than 1% interest. We bought Bitcoin. We bought the Bitcoin around 20,000. Bitcoin kept going up. That bond was the best performing bond in the year in the US. No one had a better bond. Okay, at this point, people are starting to think that MicroStrategy likes Bitcoin. Bitcoin keeps going up. MicroStrategy stock goes to 1,000. When it gets to 1,000, we go back to the market to offer a $600 million bond between 0 and 50 basis points yield, like 37 to 50% premium. The bond's oversubscribed. We make that bond a $1,050 million bond. We sell it at a 50% premium that yields 0. So we raised $1,050 million in one day at a 0% interest rate to buy Bitcoin with a strike price of $1,432 a share. Brian, remember when I started the journey, my stock was $120 a share. Our stock went up and we sold $1 billion in essence, equity at 10x that. Now there's a bond related to it. So we were providing downside protection. We bought Bitcoin with it. So now we've got another capital transaction. At this point, people get the idea that we like Bitcoin. People and
is this the craziest years of your? Is this the craziest year of your life? Easily.
Yeah, I think so. It's going to get better because our strategy was we're an enterprise software company, and people said, "Well, are you a hedge fund or an enterprise software company?" And I said, "Well, let me clarify it. We have two strategies now. Our first strategy is grow the enterprise software business. Our second strategy is acquire and hold Bitcoin." Okay, that's our strategy. We put it in our 10K. We publish it in February. So people just read it. Acquire and hold Bitcoin. What do you mean? Well, what I mean is when Howard Hughes went to Vegas, he looked at Vegas and he said, I think one day there'll be a great city in the desert that supports tourism, conventions, and gambling. So he bought all the land in the desert. Well, what was his plan? Just to buy the property. Well, how long? To hold it forever. People are still building houses on land that Howard Hughes bought, and he's been dead for 50 years. Summerlin is a Howard Hughes project. They're building entire cities on land that Howard Hughes bought. It's just a property development strategy. If you could buy all the land in Manhattan 300 years ago, in what day or what year would it have been wise to sell the land in Manhattan? Just hold it. Buy it, hold it. So that's what we did. We adopted it as a strategy, and eventually we got to May and June. And in June, we went back to the market. We got a credit rating from Moody's and S&P, and we issued a senior secured debt offering, and we raised $500 million at 6 1/8% interest. It wasn't a convert. There's no equity. It's just straight debt, corporate debt, to buy Bitcoin. And why did people buy that bond? Because they're getting a very fat coupon. They're getting 6 1/8% interest, and the junk bond index is 3.9% interest, and Apple Computer would be paying them 1.5% interest, and the Federal Reserve would be paying them 1.2% interest, and so they're actually getting yield. And we took the money, we put it into Bitcoin, and Bitcoin's part of the collateral. So now we have a Bitcoin collateralized senior secured note. And why did that work for the company? Well, because it's increasing the upside for our equity holders and the convert holders. Now they've got more Bitcoin. If you're long Bitcoin and Bitcoin doubles, well, we bought 13,000 Bitcoin and they're going to double. And then you're going to get the equity upside. The debt holders are going to keep getting their coupon.
And are you going to keep doing this for the foreseeable future?
So I'll give you the kicker. Not only did we go from $500 million of assets yielding 0% interest that were valued at nothing by the shareholders, we also flipped it to 105,000 Bitcoin, and you do the math, at 35,000 a coin, it's $3.7 billion in assets that are now an appreciating asset. Bitcoin's been appreciating 120% a year for a decade. It's up 270% in the last 12 months. You can reasonably make the argument it's a monetary inflation hedge. If it just goes up at the rate that the central bankers print money, it should go up 15 to 20% a year. Any number. By the way, I have $2.2 billion of debt, and I pay $35 million a year in interest on it. That's like about 1%, 1 point. Figure it out. We borrowed 1.2% at less than 1.5% interest rate. And the arbitrage, if it yields 20%, is like you've got billions of dollars that are yielding an 18% arbitrage in a conservative situation if you can stomach the volatility. So we flipped the company from being asset poor to asset rich. And here's the irony, Brian. The brand of the company got 100x stronger. All the employees got wealthy. They're happy. All the shareholders, the stock went from 120 to 630. The stock went up by 500%. The shareholders The shareholders benefited, the employees benefited, the customers are happy, the company is now well endowed, the brand was burnished, our distribution channel increased, and our top line grew 10% year over year in Q1. And so the growth rate of the company increased because of the awareness of the world to our value proposition. So even the operational part of the business was improved by the balance sheet strategy, kind of in the same way that if I said, guess what? Harvard, Yale, and MIT have massive endowments. They're super rich. If you're a student or a professor, you'd rather go be a student at the well-endowed university, and you'd rather be a professor at the rich university. If I said Harvard gave up their entire endowment, they gave it back to the donors because they couldn't get a yield on it. Now they have about no money and they're within 4 weeks of bankruptcy. Who wants to go be a professor or a student at that university? So what we did is we basically endowed the company in order to revitalize the company. And that's why I say often Bitcoin is hope.
And you have also become probably the most famous Bitcoin evangelist in the world in the process and been embraced by the community. I mean, what's that been like for you? Because that's a transformation.
It's easy to be depressed in the depths, of March of 2020, right? A lot of people went through a difficult time period, and what does Mark Twain says? Two most important days of your life are the day you're born and the day you figure out why. And so I think it's been very revitalizing for me. It's been revitalizing for MicroStrategy. It brought me in touch with a lot of brilliant, passionate, progressive, idealistic people. I like being plugged into the mission, and I like being plugged into the community. The community is just very motivated and passionate, and just like that MIT story where I said just a lot of very intelligent, bright, young people doing cool things. When I got to MIT, I see a lot of people in the Bitcoin community very passionate, doing very cool things. When I describe Bitcoin, I say it's an economic imperative, it's a technology imperative, and it's a moral imperative. The economic imperative is $400 trillion worth of currency and currency derivatives that are being devalued by the currency devaluation. So everybody in the world has this problem, right? So it's motivational to have a solution to the problem faced by every investor on the planet. If you own bonds, it's $100 trillion worth of bonds with a negative real yield. If you own commercial real estate, your commercial real estate's got rents capped at CPI, which means you have a negative real yield on real estate. If you own value stocks, the value stocks are valued based upon the discounted value of the cash flows. If you have a utility company growing cash flows at 2% a year, and if the currency is devaluing at 15% a year, you've got a negative real yield on your cash flows. So everybody in the world sitting with cash or currency derivatives has a problem. We've got a solution. That's pretty motivational. I think from big tech, if you look at the tech imperative, this is what Bitcoin is to me. Bitcoin is digital property, which means that if you wanted to give joy to 5 billion people, you would give them digital music on a mobile device, Apple Music, Amazon Music, Pandora. That's how you give music to 5 billion people. You can't give them an orchestra or a Steinway grand piano or a phonograph or a record or a CD. You just can't do it that way. The 20th century music solution is too expensive and cumbersome to give music in the 21st century to everybody. If you wanted to give education and erudition to 5 billion people, you can't do it with MIT and Harvard and libraries and books and teachers and professors. You need to do it with digital books and digital education. You need YouTube and iBooks, and that's why Google and that's why Apple are exploding in value. if you want to give wealth to 5 billion people, Brian, you can't do it with gold. You can't do it with land. You can't do it with buildings, and you can't do it with 20th century stocks. You can't do it with collectibles and art. You can't do it with diamonds. Those are 20th century property. They work for the elite. You can give 10% of the people wealth that way. You can give 10 or 20% of the people wealth with banks and stock exchanges. If you want to give 5 billion people wealth, you need to give them digital property. You need to give them digital gold on an open monetary protocol running on a $50 Android phone. And that's what Bitcoin is. Once you understand what we've got here, you put Bitcoin together with an Android phone with an application. It could be a layer 2 decentralized application like Lightning, or it could be Square Cash App, or it could be PayPal, or it could be Apple Pay or Google Pay. But when you put together mobile devices with software and you plug it into digital property, you have the means to give everybody on Earth property rights. And you can move it at the speed of light, and you can make it as smart as your iPhone or your Android phone can be smart. And there's no one on the planet that hasn't figured out digital photos, digital video, digital books on a smart device is a better idea, and it's the way to create a utilitarian entitlement. And so when I say it's a tech imperative, I mean, A, it's a pretty good idea for Google, Apple, Amazon, Facebook. And if they don't do it, then Jack Dorsey at Square or PayPal is going to eat their lunch and do it for them. You can't stop that. The genie's out of the bottle. But I also say it's a tech imperative because they have to do it, right? It's like they have to do it because, you know, iCloud with your photos and your videos is interesting, but iCloud with $100 trillion of your money is compelling. You know, when Apple doesn't do it, Facebook's going to do it. And if Facebook wants to push back against Apple, they need to put digital property in the Facebook app. So it's coming, and it's the next chapter of the mobile wave. You know, it's like mobile property in the palm of your hand. When people don't get it if they're elitist in the Western world. Yeah, you live in Manhattan, you got a bank, and you have you have your money invested in NASDAQ. Okay, well, good for you. What's your solution to the 2 billion people in Africa and in Asia and South America don't live in Manhattan, don't have a bank account, don't have a brokerage? You know, the 1.7 billion people on the planet don't have a bank, and when they actually make some money, they can buy the local currency, and the local currency is devaluing at 80% a year. Okay? That's what people don't get. So the next big tech move is digital property on mobile devices, and that takes me to the moral imperative. The moral imperative is you want to give property rights to 8 billion people on the planet. You're not going to give it to them by preaching. You're not going to give it to them with politics. You're not going to give them books. You can't physically ship 1 ounce of gold to everybody on the planet. And if you could, there's a 40% markup, a 30% markdown, a 6-week delay, and you can't program the gold. How am I going to actually build a 21st century economy on a rock? I can't do it. And I can't do it with the 20th century banking system. The 20th century banking system is a couple of central banks wired through thousands of fractional banks that don't operate on the weekends or the evenings. If I wanted to do business with a company in Nigeria, it would take me 25 years. If I took $1 billion, Brian, and 25 years, I still could not do business with a company in Nigeria or Zimbabwe. I cannot do it. You could spin up a mobile app in Nigeria that accesses the Bitcoin protocol and plug it into another mobile app in Argentina that's plugged into another bank in Syria, plugged into a retailer in Iran, Iraq, Russia, the US, Manhattan, Wyoming, and Mexico. And you could thread that together using the open protocols of Bitcoin as a settlement layer and Lightning as a transaction layer And you could do that without asking anybody's permission, and you could do it now. And is it happening? Yes, it is happening right now. It's happening in El Salvador right now. So the thing that's most exciting to me is there's a lot of academics and a lot of politicians, and they preach, let's make the world a better place. But when you go to MIT and you look up on those buildings, and you see all the great scientists, and you see Maxwell, right? And you see Edison, and you see Einstein, and you see Newton, you're reminded that if you really want to better the human condition, give them fire. And when you're done with that, give them electricity. And when you're done with that, give them antibiotics and then radiation, right there. You need technology. You're not, radio, right? We went from a life expectancy of 50 to a life expectancy of 70 from 1900 to 1950. We didn't do that with preaching and politics and elections. We did that through the conquest of infectious disease, and that comes down to two ideas: sterilization and antibiotics. And so what does it mean? What are property rights? I mean, life, liberty, and property. John Locke gave us that idea. What does it really mean? I'll give you a biological metaphor. If you're a type 1 diabetic, you can't form insulin, which means you can't create fat. What is fat? Fat is an organic battery. It's a battery to store organic energy. Nature came up with a battery to store organic energy. Insulin is what actually converts the excess energy into fat. If you have it, you live 90 days without food. If you don't have it, you eat nonstop and you starve to death. Property is socioeconomic battery. And so if I have an excess 3 months worth of salary and I can store it in property, it means I can lose my job and not starve to death. When I deprive you of property rights and I deprive you of property, you live hand to mouth, which means in the week when you lose your job, your children go hungry. So yeah, in America, when you have a bank and you store dollars and they lose 1 or 2% of their value a month, it's just a problem. When you live in Africa, you don't have a bank and you can't store dollars and you have to keep money in a local currency and it loses 1 to 2% of its value a week. At that point, you've lost your property rights. And if you've lost your property rights, it's hopeless. It is a type 1 diabetic can eat nonstop. They starve to death. It's a death sentence. The lack of property rights is a death sentence. So if you want to give, what do you see happens? Well, literally some people starve to death, but when you have hyperinflation like the Weimar Republic, when you have hyperinflation in Zimbabwe or Venezuela, or you see the kind of inflation that's coming and is manifesting in Argentina or is in Syria or Lebanon lost 90% of the value of the currency in 1 year. The government devalued the currency 90%, froze everybody's US dollar balances in the bank. If you had money in US dollars or in Lebanese pounds, you lost 90 to 95% of everything. Okay, so where's your property? How do you eat, right? That's the problem with losing property rights. So what happens when you have hyperinflation? It's like you become a diabetic, a type 1 diabetic. Your batteries start to drain. What you get is a collapse of the currency, a collapse of property, and you get ripped back to the Stone Age barter. So, the entire modern economy collapses if you don't have the ability to store economic energy, and that causes the collapse of the society, and we can see that.
And Bitcoin will potentially solve all that. There
Bitcoin
it is.
solves all that.
You have all that property, and now everyone can access it, and it's now so clear to you that this is the solution. And again, it's tech, so it works. So give the people the fire and let them use it. And And this is
Bitcoin is fire. Bitcoin is electricity, right? Bitcoin is not a speculative, uncorrelated asset, right? So when people get beyond that, what's going on right now, Brian, is that as the U.S. dollar expands, and let's say we're devaluing the dollar 20% a year, maybe, and we're going to keep doing it. All these strong currencies are also devaluing at 20% a year against scarce assets. That's why you have asset bubbles. That's why housing is up 25% in the U.S. year over year. That's why the S&P is up 35% or 38% year over year. That's why the S&P had 7 consecutive days of all-time highs and 7 consecutive months of all-time highs, and looks like this. There is no price discovery in bonds. There is no price discovery in stocks. There is no price discovery in property. As that's happening, other weaker currencies are falling faster. So there's a set of currencies that are devaluing 20% against scarce assets. They're the good ones. There's another set devaluing 40% a year against scarce assets. They're the middling ones. The weak ones are falling 80% versus scarce assets. That's where you've got hyperinflation. You can see that happening. All of those countries are going to lose their currency privileges. Their local currencies are literally collapsing. In El Salvador, their currency collapsed after the civil war 20 years ago. They had to dollarize. Okay, well, nice idea, let's dollarize. Okay, fine. If I don't have a bank, how do I get dollars? Yeah, right. You remember the history of the Chesapeake Bay is the settlers came here in the 1600s. They didn't have pounds. They didn't have currency. They used bales of tobacco as their currency, right? When you don't have dollars and you can't manufacture dollars, what are you trading? Seashells, tobacco? What? Okay, so what's going on here? What's going to happen? This is the end game. Everybody has an Android phone. It costs $50. If they're rich, they have an iPhone. The wealthy have an iPhone. The working class and the poor have an Android phone. You've got a digital wallet, and you've got digital currency in it. The digital currency is not going to be the Zimbabwe dollar. It's not going to be the Bolivar. The digital currency is going to be the U.S. dollar. Everywhere in the world where U.S. is the predominant political influence, the Chinese would like it to be the CNY. They'd like it to be the RMB if they could. So you're going to see a little struggle between digital currencies in the China sphere of influence versus digital currencies in the Western sphere of influence. People are going to use those dollars to buy coffee. They need digital ones. So they'll either be stable coins running on a crypto network like a Tether, or there'll be a digital dollar that came through a centralized solution. El Salvador legitimized Bitcoin as tender so you could swap between Bitcoin and dollars using the El Salvador banking system, and that's how they do it. But everybody's going to have that digital wallet, and you're going to have digital currency, which is like a dollar or CNY or euro, or maybe the yen. There's only going to be about a dozen. The world only really needs a dozen strong currencies, and most of them, I could argue that every Western currency is pretty much pegged to the dollar. Even the CNY, Brian, is pegged to the dollar. It's pegged to the dollar. Everything is pegged to the dollar. And so the US dollar will be the world's reserve currency. It's going to move on these crypto Bitcoin rails. And then the underlying, the other part is going to be digital assets. People want to hold digital currency and digital asset. The assets hold their value. The currencies devalue 1 or 2% a month if they're good. They devalue faster. But when you devalue the currency 85% a year, everybody wants to get rid of it. In Venezuela, they want to trade their bolivars for dollars, and then they'll want to trade their dollars for Bitcoin.
Right.
If you need to spend the money in the next 12 months, you're going to hold currency. If you need to hold the money for the next 12 years or for the next 100 years and give it to your children and your children's children, you need property. So call it an asset, property. So what you're going to see is mobile devices with the currency in one layer and then property or asset in the other layer. Bitcoin is the king of the assets because it's the most secure, most likely, it's got the strongest integrity, the greatest durability over the next century. The US dollar is the king of the currencies. It is the world's reserve currency. Most of the world, you're talking billions of people in South Africa, in South America, in Asia, in Africa, they're going to want to flip to the dollar and the Bitcoin. That's the 21st century ecosystem. And they'll augment those wallets with some other assets. If you can hold an equity token or an Apple stock or whatever, you love it. If you hold some rights and privileges, you will. And they'll want to hold maybe some local currencies. If by law I have to pay my taxes in euros or pounds.
So you mentioned Tether there, and I'm glad you brought it up. And you mentioned maybe a token or maybe a synthetic equity asset. Right now, these things are considered DeFi, right? Decentralized finance. Most of them are based on the Ethereum network, which came a little bit later than Bitcoin. We know the whole story there. It had the smart contracts, and again, all of this brain power went there. And Michael, that's what caught my eye a few months ago in this space, is that I saw the rate of growth of some of these instruments at a rate that I hadn't even seen in the 1990s. When I worked at Bankers Trust on Wall Street, we were putting together some exotic risk. We were probably one of 10 or 20 shops in the world that were packaging these products for customers. And some of these things were high level concepts to understand in finance. And yet I saw this happening in a decentralized way. And I was like, wow, this feels like next level growth. I've never seen anything like it. And that's what attracted me to this ecosystem. But that's a very different thing than Bitcoin. And you've made an incredible argument for Bitcoin. Where does Ethereum come into play? DeFi, smart contracts. Obviously, Tether's on there. Tether's got quite a big market cap right now. And I agree with your train of thinking. It's like there's the currency, there's the property. That currency, you mentioned Tether. What will play out when it comes to Ethereum?
Let me give you an interesting magic quadrant for you.
Okay.
If you want to take the entire crypto universe and divide it into 4 quadrants, you've got property, you've got currency, you've got platform, and you've got application. And what is property? And that's the decentralized economy. Okay, there's a centralized economy, a traditional economy. There's property. There's platform, there's application, there's currency, there's the centralized world, the decentralized world. So once you understand that, decentralized property, right? The leader is Bitcoin. What is it? It's engineered for integrity and trust over the long term. What do I want it to do? I just want it to be here in 100 years. I really want it to be here in 1,000 years. Do I want to change it? Not really. Okay. In Manhattan.
It has low ambitions, right? You like that it has low ambitions because it does what it says on the tin, as they say in the UK. You like it the way it is because in that sense, it'll be durable and it'll store value for 1,000 years. That's why you like it.
I want indestructible inertia. Okay, so if you think about Manhattan as the metaphor, and you're in Manhattan, I've got a city block in Manhattan. I'm hoping Manhattan's made of granite. That's why it's Manhattan. It's well located too. So a granite city block in Manhattan. Okay, Bitcoin is 21 million blocks of cyberspace. And what do I like about granite? It's heavy, it's inertial, it's indestructible. And if I build a 100-story building on it, it won't sink. You know, there's other places. There's very, very tragic surfside accident in Miami Beach. A building sunk, built on sand. Okay, you want to build something? You want to build it based upon granite, a strong foundation. That's your property. There are other properties. Ultimately, generally what you do is you pursue a proof of work, decentralized mining architecture. The way that you get that granite indestructibility over time is you're securing the network with a lot of energy. You're securing the network with a lot of technology. The 7th generation SHA-256 ASIC miners, that's a lot of technology capital. You're securing the network with a lot of political capital, like the governor of Texas, the nation state of Iceland, Canada. They have a lot to gain, so they'll protect it. You're securing the network with a lot of human capital, all the mining operations. and you're securing the network with a lot of external financial capital. I put billions of US dollars into mining facilities, which are then mining Bitcoin. And so everybody that's got a vested interest in that has now got a vested interest in defending Bitcoin and preserving the integrity and not having anybody change it, right? A lot of vested interest. So that's the architecture for property. There are other crypto asset networks, Bitcoin Cash, Bitcoin Satoshi Vision, Dogecoin. They're properties, right? Obviously, I have an opinion about which one is the safest bet. Bitcoin feels like the risk-off, right, crypto property network, right? It's the Manhattan in cyberspace. One day, I think billions of people want to live there. Now, you've also got digital currency. You're in Manhattan. Let's say I give your family, Brian, $1 billion, and I say, invest it for the next 100 years. Or you can buy $1 billion worth of land in Manhattan, buy $1 billion of Bitcoin. Okay. What else can you do? You can buy $1 billion worth of US dollars. Okay, that's buying the digital currency. If you buy $1 billion worth of Tether, you're just buying the currency. Is it a good idea for the long term? Not really, because it's going to devalue at 1 or 2% a month or 7% a year or whatever. It's meant to devalue. You're tying yourself to an asset which is tied to the fiat economy. Is it a good idea if you need to actually buy $1 billion worth of stuff tomorrow? Yeah. Who needs to buy $1 billion worth of stuff tomorrow? Traders, exchanges, right? Insurance companies, banks. What if you need to buy $1 billion worth of stuff in 6 months? It's a good idea. Like, you need it for working capital. MicroStrategy has $50 million worth of dollars as working capital. We have billions of dollars worth of property. The $50 million is what we think we need to trade with to pay our employees, pay our vendors for the next year. Okay, so that's working capital. That's the best use of digital currency. Who needs it? Well, how about like 1.7 billion people without a bank that would like to use US, from their point of view, the US dollar is an alternative to the Bolivar or to stone rocks of the Yap people, right? I mean, or the bales of tobacco. Pretty good idea to run an economy that otherwise is constrained to Stone Age barter. How do you sell your services to someone in Manhattan when you live in El Salvador over an internet connection if you don't have digital currency? Okay, so it's not a bad idea, right? My friend Eric plays chess with me. He pays somebody in Siberia to give him chess lessons. It's a lot cheaper than paying someone in Manhattan to give him chess lessons. The guy in Siberia gets a good deal. Eric gets a good deal. Eric needs all the help he can get. Eric, if you're listening, right?
So that's the currency.
That's the currency, and that's the lubrication to turn on 8 billion people in the economy to trade with each other on $50 phones. So yeah, it's useful. Tether is the leader in the decentralized, in that space, They're using a proof of authority, some architecture.
Yeah. And that's on the Ethereum network right now.
Yeah, and I am not an expert on all the intricacies. All I know is there's a stack of digital currencies, right? Tether, DAI. Some are more decentralized than others. They're sort of private, and over time they will compete in a way with CBDCs and state-issued digital currencies, and there'll be pros and cons, right? Just like digital property, Bitcoin competes with real property.
Yeah.
You can buy gold, you can buy land in Kansas, you can buy Bitcoin, right? There's that flow, and there's flow between digital currencies. Why would I want it? Because it moves at the speed of light on Saturday afternoon to a $50 Android phone, and US dollars don't. That's why you would want it, right? And the third quadrant is digital platform. Ethereum is the leader of digital platform. And the idea is let people build everything you could possibly imagine in a DeFi architecture and make it work at the speed of light on a Saturday afternoon. And you don't have to go through the traditional banking and the traditional brokerage and traditional every system. And then the fourth is digital applications, decentralized applications. A Uniswap wants to be an exchange. Somebody wants to be an NFT. Somebody else wants to be there's maybe a license or a provenance or whatever. Your imagination is your limit. Now, the decentralized apps compete with centralized apps. Decentralized platform competes with Ethereum versus AWS, Bitcoin versus Kansas, Tether versus the dollar and the Fed wire, okay, and Visa and Western Union. And, there's a lot of answers, right? Like Western Union costs a lot of money, and Tether doesn't cost a lot of money to move it. And then there's lots of jockeying. There's competition. I have a Bitcoin versus my most popular podcast, Bitcoin versus gold, more than 1 million views. I think that gold is the 19th century property and Bitcoin is a 21st century property. But the market is deciding where the money is going to flow. Tether is competing with, and will compete with CBDCs if they ever show up. But until then, it will compete with Western Union and Visa, right? And Ethereum will compete with, centralized stuff. And the market will sort out, who wins, who loses, right? And maybe there's lots of winners. And maybe multiple people win at the same time, and certainly there'll be losers, right? Because that's the way it works. And then you'll also, in addition to the market competition, you'll have regulatory clarity, right? There's a certain set of regulations that apply to currencies. There's a certain set of regulations that apply to property. Guess what? If you transfer $1 billion of Bitcoin, you got to pay tax on it, property tax. On the other hand, you transfer $1 billion of currency. There's no tax on it, but there's KYC, AML. There'll probably be some KYC, AML on property too. And then with platforms, maybe some platform. There are rules that we apply to platforms. There's a big political debate about Facebook and Apple and Google and their obligations, and Amazon, their obligations as platforms, right? What's going on. There'll be platform issues. And then finally, there'll be applications. You want to be an insurance company and you want to sell life insurance to like 16-year-olds. On the day that a 16-year-old buys life insurance on their parents and then they kill them, there's going to be somebody is going to show up, digging around saying, did you sell an insurance policy to a criminal that collected on it? I have a colorful imagination, Brian. So please take that as just a random hyperbolic example. But if to the extent that you want to be a decentralized application and if you want to sell future derivative swaps in London, the regulatory authority that is concerned with future derivative swaps in London may be interested in you, and then you have to deal with that.
Right, which isn't a risk that you necessarily want to mess with because you're like, I'm property and Bitcoin's the property. And I like that it doesn't have big ambitions. DeFi, on the other hand, does. I mean, it really wants to just mow down the banks. I worked in banking for 15 years. I'll be honest, Michael, I personally want to mow them down as well because I saw from the inside the way they stopped innovation. They stopped people having access. And there's no need. 30 years ago, I was doing some of the things that now the kids are doing on these D-apps right now. Why did it take so long? And why can't these people you talk about, these 2 billion people around the world, have access to these complex instruments? So I'm on this, maybe I'm a rebel anyways. Maybe that's why I, fought against freedom of speech last year and ran for mayor this year in London. But I want to wreck it. But I think you're sensitive to the fact that that comes with it, regulation issues, and they're going to be real. And DeFi is going to have to go through those hurdles. And meanwhile, Bitcoin as a property might not. And that's the way you see that. Is that correct?
Yeah, I mean, I think that innovation, like we're all in favor of innovation. It's a question of who can do what. Like Uber was illegal in half the jurisdictions that they do business in, but I still like Uber.
Yeah.
But they fought, Airbnb in Miami Beach. Airbnb is illegal, but people are doing Airbnb. And so if you ask me, how do I feel about that? They're both successful unicorns. They're making the world a better place, but there's friction. But I also can see the point of view of the taxi cab drivers have, I bought a medallion in New York City and I paid hundreds of thousands and you bankrupted me, by coming into my town. And like, what about me? And maybe the guy that's got the apartment next to the party house that's got 100,000 parties going on, maybe that guy thinks I bought the apartment and the condo association rules are you're not supposed to do this, and Airbnb's making my life difficult. There's friction with innovation. I think that just like the magic quadrant model is useful with crypto, it's like figure out what you're investing in and then start to work through the competition issues and work through your ambition and work through the regulatory issues. I think there's another quadrant or another segmentation, which is the investors segmentation. Are you a saver? Are you an investor? Are you a trader? Or are you a speculator? And the way I think of it is a saver is someone that simply wants to keep their money for 100 years. You want to preserve your property, right? Brian, if you would like to give your money to your grandchildren and you want to put away some bucket of money for your grandchildren and not think about it, the traditional technique is I buy some gold and I bury it, or I buy land, or I buy something which is stable, like and I buy Bitcoin. I swap a weak asset for a strong asset. If you live in Argentina and I told you the currency is going to go from 1 peso to the dollar to 155 pesos to the dollar, so what's your strategy? Well, I just sell pesos and buy dollars. Okay, but what's your mix of real estate versus stock versus crypto? Like, no, you're overthinking it. I just sell the peso, I buy the dollar, because that way I'll have 155 million pesos instead of 1 million pesos in 20 years. That's the idea. Okay, that's a saving strategy. Buy the strong asset, sell the weak asset. That's a 100-year time frame, 10-year time frame. I'm an investor. An investor is I buy Apple, Amazon, Facebook, Google because I think they're going to go up by a factor of 10 and they may be cut in half. If you show me a company that would go up by a factor of 10 where I might lose half my money, I would say if I believe in that company, that's an investment proposition. I can get behind that. I'm buying a business. It's much riskier than saving. See, the thing about Bitcoin is if I took big tech and I ripped off if I took away the product and the CEO and the board of directors and the company and all the employees, and I just left the big tech and it didn't ship anything and nobody worked for it, can you see how that is less risky, less moving parts than when you give Apple, Amazon 1 million employees, you can unionize them. And when you give Apple 10 products, they have to upgrade them. And then when you give Google a headquarters, well, you can regulate them. And so when you give the company stuff, people, you create more attack surfaces. So that's why with Bitcoin, I can imagine if I buy 100,000 Bitcoin and it is whatever, 0.5% of the network, maybe I'm holding that 1,000 years. Well, Mike, what has to happen for that to be valuable in 1,000 years? Nothing different than what's happening now, right? So savers have a view, they just want the land. The investors, they're taking a different risk proposition. The traders, well, they're betting on risk derivatives. Like, to be right on Apple stock, you just had to hold it for a decade. But if you're a trader and you were trying to guess whether the quarterly results would be well so you could buy the call or sell the put, you have to actually, not only do you have to guess whether they print a good quarterly number, but you also have to guess whether the market has already assumed that they're going to print a good quarterly number, and you have to trade against the sentiment of the market. Okay. So you're trading the shape of the yield curve, and you're trading dynamically risk derivatives, the first and the second derivative of risk. If you're a good trader, you know you are. And then the last thing is speculator. I don't even know what Apple's going to print, but everybody's talking about it, so I just bought the stock to see if it'll go up. All right, I bought Dogecoin before Elon Musk goes on to Saturday Night Live to see if it goes up. But that's a different thing. I think that if you have a bucket of money that you just want to save low risk, you do a saving strategy. And if you didn't like Bitcoin, I would say buy a stack of market basket of scarce assets that are going to hold their value in an inflationary monetary environment that nobody can screw up. You just want to, I'm just going to buy a trophy asset. I'm going to buy beachfront property. I'm going to live in the rest of my life. I'm going to buy something which you can't mess up. Very simple. An investor, you have to cherry pick from 500 different stocks in the S&P 500 to pick the right one. Okay. But then if you're a Warren Buffett investor, you buy it, you hold it forever. He's still holding Coca-Cola 40 years later. Okay, that's fine. The trader is, you better have proprietary liquidity or proprietary algorithms, or you better be in between two inefficient markets. If you are, you know you are. And if you don't know that you're the best in the world at this, you probably aren't, and you should probably stay out of it. And I don't begrudge anybody being a speculator. It's your right. I mean, if you want to go to Vegas and bet money, go do it. If you want to bet on yo-yo coin, go do it, right? But only bet what you can afford to lose, and call it that's your gambling entertainment bucket, and maybe you make money. And I mean, people make money in Vegas. Maybe on the margin, your odds might be better, in certain places than other places. If I could just end with one geographic metaphor, coming back to this New York analogy. If Bitcoin is a block in New York City, then the currency is a bunch of dollars in New York City. The platform is a 100-story building, the Rockefeller Center in New York City, right? And the applications are companies in the Rockefeller Center. Roll the clock back 100 years. Would you rather own the land underneath Rockefeller Center? Would you rather own the Rockefeller Center? Would you rather own the banks, the insurance companies, the restaurants, the discotheques, the retailers, the condos in Rockefeller Center? Or would you rather own $1 billion worth of money in a vault in Rockefeller Center? And that's your four different things. Figure it out. I would say you can make money in any of the four. If you're going to own the dollars, you better be a trader, because you can't hold them that long. You better be trading. If you're going to own the platform, you're going to be a landlord, and you're going to have some tenants go bankrupt and other tenants hit it big, and figure it out. I think that the block in Manhattan is good for 1,000 years. I think the building's good for 100 or 200 years before you have to rebuild it. That's okay. I mean, Rockefeller Center's still there. They put it up in 1930 something. But you gotta renovate it. If you want to own the company, man, companies, they could last. Name a company that's 100 years old. They could last 10 years. They could last 20. They could last 30. They could also last 30 months. But on the other hand, Brian, if I had infinite capital, if you have $1 billion and you just want to put the money to work in a brainless way, you buy the property. But if you don't have $1 billion and you want to make $1 billion, if you start with $1 million and you want to make $1 billion, maybe you want to start a company. Like, in fact, maybe I'll say, like, I started with a $5,000 furniture loan at age 24. In order to create a multi-billion-dollar company with $5,000 of capital, you better start a company. You need to invent something. So if you don't have any capital, but you have, if you have intellect and passion, ambition, you start on the application area and then you move backwards.
Yeah.
If you have a decent amount of capital, maybe you can have a building, a platform, and you're hedged in the middle. And if you have a lot of capital, you buy property. And I think they all appeal to different pools of capital. And they all, the marketplace will sort it all out. But it's important to keep in mind that there's a lot of $400 trillion of the money in the ecosystem is CeFi, it's traditional finance. And so if you want to see this thing really explode, what you want is for the insurance companies, the Mass Mutuals, the New York Lifes, the AIGs, you want them to rotate $100 billion portfolio that's all bonds into 30 or 40 or 50 or $100 billion of Bitcoin. And then as they rotate their traditional bond assets into digital property, the entire ecosystem will expand, and then you can start to use that digital property as collateral for the next thing and the next thing, right? And there's a place for both, right? I mean, some people think the only innovation is in the DeFi apps. Well, I mean, you need to do DeFi apps to bring innovation to certain parts of the economy. Like if you want to when we wanted to bring stablecoin to El Salvador, you needed Lightning on Bitcoin and it was DeFi, and you couldn't do it with Visa. But on the other hand, there's also massive opportunities for Apple Pay and Google Pay. You can also convert Apple into the world's biggest bank.
Right.
I mean, Bitcoin means that Apple could become a bank with $10 trillion in assets in 36 months or 60 months. Okay, that's a different thing, but it's also possible you could have a DeFi network that spins up with hundreds of billions. I think it's more likely that you'll see mega capital flows as the big tech players like Facebook and Apple and Google come in, because they have incredible leverage they can bring to bear if they start to embrace even a piece of the crypto ecosystem.
Yeah, and I think everything you just said you should teach at a class at the Sloan School of Business at some point, Michael, because it was pretty good, pretty tasty, those two quadrants. Just a couple final questions before you go. You mentioned potentially those FANG companies maybe doing what you did with MicroStrategy, taking chunks of their treasury or leveraging into these markets. Are you surprised more companies haven't? Obviously, it seems like you talked Elon into it. And I don't know if he didn't necessarily get rid of his Bitcoin, but obviously I guess they're not taking it. So just thoughts on that. And then finally, just how this all plays out with China. Just would love to get your closing thoughts on that.
Okay, so with regard to corporate adoption, corporate adoption of Bitcoin has exploded over the last 12 months. If you roll the clock back 12 months, let's go back to July of 2020, I did a search. I think I found one company that had held like $2 million worth of Bitcoin for a period. That was it. And so if you look today, there are billions and billions of dollars spread across a couple of dozen companies, 2-3 dozen public companies. So,
but you and Elon are the big people that have invested, right? No one else has gone into the billions, right?
We're the biggest, but Tesla's still got billions on its balance sheet. And then if you go to Galaxy and Marathon and Square, they've got hundreds of millions. So we've made good progress in the first 12 months. But generally, the challenge for publicly traded companies is that digital assets and accounting for digital assets, right, is not kept up with the rate of growth of the industry. So the traditional GAAP accounting treatment in North America, in the US specifically, is indefinite intangible, which means that if you buy $1 billion of Bitcoin and it trades down 20% for a minute, and then it increases by a factor of 10, when you report the period, you have $10 billion of real Bitcoin, but you would report that you have 800 million worth of Bitcoin, and there would be a $9.2 billion difference between the pro forma fair market value and between the indefinite intangible book value. And that creates opacity and confusion, and then you would have to create pro formas to explain to your outside shareholders where the $9.2 billion went, or, do you have 800 million or do you have 10 billion? Okay, so if you're a traditional CFO or treasurer and you have a beautiful P&L and a beautiful balance sheet, then putting a lot of raw digital assets on the balance sheet in that form where you get that indefinite intangible accounting treatment would give you pause. Now you have the other option. You could actually buy it as a fund, then you hold a security, and then normally most of the time the securities are fair value accounting, and then you'll be showing $10 billion of security. But you run into all sorts of other issues, like there's the SEC 40 Act, where if you have more than 40% of your assets in securities, you trip that act, and now you're a different type of company, you're a finance company. And so all of a sudden you have conservative CFOs and lawyers saying, well, if we do it this way, then we got this accounting optics issue. If we do it the other way, then maybe we have this 40 Act issue. And so let's think about it a bit longer. And then, of course, if I actually bought $1 billion of Bitcoin and it went up by a factor of 10, I would have a $9 billion capital gain. And if I ever wanted to transfer the Bitcoin from one custodian to another custodian, like I've got $10 billion in one bank in Singapore wants to give me 10% yield, and so I can make $1 billion a year. But I've got it tied up with the first fund, and they're giving me 1% yield, and so I'm losing $900 million a year. But if I want to transfer it, I can't because I don't have the custodial rights to the Bitcoin, so I have to sell it. So when I sell it, I get a $3 billion capital gain tax. So you can see the complexity here. Which is a complex. You don't have it if you're an individual, and if you're a private office, and if you're a fund, you don't really have that complexity. But there are certain classes of investors that have certain complexities on this, and that's why it's not the simplest thing. I think that over time, we will see, there's already an awareness that the accounting is not necessarily most straightforward. And a congressman, Tom Emmers, wrote a letter to the head of FASB, signed by a bunch of other congressmen, saying, hey, could you take a look at this? There's an awareness of that. Whether anything changes, who knows, right? And it's different in different parts of the world. But that's a long-winded answer to what's going on. There are asymmetries in the market. We could sit and we could whine about it, and we could feel sorry for ourselves about it, or you could flip it around and say, that's your opportunity, Brian.
Yeah.
I mean, MicroStrategy went through the process of rotating our shareholder base to actually educate them. And so now that we've done that and people look at our Bitcoin holdings and our performance, it's actually a benefit. The other thing we did is we issued equity, converts, and senior secured debt, which are Bitcoin derivatives. And that means that if you're an investor and you want the Bitcoin exposure, but you'd rather own the security, well, maybe you'd rather own the MicroStrategy security than the Bitcoin. And so instead of complaining about the problem, be the solution to the problem. I could turn it around and say, well, if accounting wasn't indefinite and intangible, Bitcoin might cost you a lot more to buy right now. So if they ever change that might change your risk reward scenario. So think about, are you happy that Apple hasn't deployed Bitcoin as part of Apple Pay, or are you unhappy? On the day when they announce that they're rolling it out, Bitcoin is trading up, and if you didn't buy everything you wanted to buy, then you'll be thinking, man, I should have bought more before they did that thing. So that's what I think about that. The last question is on China. You want to go into that? Do you have a further follow-up?
Let's finish on China, because that's a huge wild card. What happens there in the next 20 years?
There's a Western net and there's a China net. The Western net is Western Europe and the United States and the free world, and it revolves around the US dollar, the English language, Western law, and Western technology. And it is dominated by Google and Facebook and Twitter and Apple and the US Supreme Court and English and Amazon. And that's been getting stronger for the past 20 years. In fact, it started to form with the internet and it's got stronger and stronger. And then there's the Great Wall of China, and behind the Great Wall of China, they block Twitter, they block Facebook, they block Google. Apple, they have a love-hate relationship with, but they block most of these other things. And they have their own Weibo and WeChat and Alibaba and Alipay. They don't want Google Pay. They don't want Apple Pay, right? And they have the CNY, the RMB, and they have the Chinese language, and they have Chinese law, and they have the Chinese culture. So there's the China sphere of influence. There's the Western sphere of influence. That has been that way for quite a while, more than a decade, probably 20 years. It's been getting stronger and stronger. It was always that way, but it became visible to us after the internet revolution because you saw the VPNs and the firewalls and the like, right? There is a controlled flow of information. What you just saw with the China crackdown is it drove a China exodus. It drove an exodus of Bitcoin mining and Bitcoin holdings from China. That has been gradually coming for the past 4 years. And this was a pretty aggressive acceleration of that in about a 4-week to 6-week time frame. What does that mean? It means that people holding billions of dollars of digital property on the Bitcoin network in China, they had to sell it. They had to force liquidate it in a hurry at a discount. The winners were the people that bought the Bitcoin. My company bought 500 million worth of Bitcoin at 37,000. I would have paid double. I would have paid triple. We were going to buy it. Okay, so we're the beneficiaries. The people that sold it to me, they had to sell it under pressure in a hurry. And then the Bitcoin mining equipment, the Bitcoin miners had half the mining market. It was worth $10 billion a year. They were growing at 100% a year. It would have been worth $1 trillion to them. They had to leave China. The equipment is that the Bitcoin mining network is the security network of Bitcoin. Now it's going to Siberia and Iceland and Canada and the US and Texas and El Salvador and Argentina and Africa. It's a benefit to the rest of the world. It's a loss to China. But so is Google Maps, a loss to China and a benefit to the rest of the world, Right. So when the Chinese found out that DD was tracking telemetry of the DD network, and they shut them down. Okay, well, that's a negative, but Android tracks telemetry, and if you shut it down and you can't track telemetry, you don't get the AI that tells you how to drive, and you have to develop it yourself. So the view is, we're just going to do all that ourselves, right? The Chinese have basically, driven digital property in the form of Bitcoin out. They will try to replace it with the Chinese CBDC, but they're not replacing digital property with digital property. They're replacing digital property with digital currency. The digital currency is losing 20 to 25% of its value a year. They don't have any digital property. Control of the digital property network is going to shift to the West. Good for us. Good for the West. Good for the American way. Good for the US dollar as the reserve currency of the world, because what that means is, I got to believe 5 billion people end up on the Western net. There's already 1.5 billion on the China net, and I guess if they get another billion, the big question is it 2.5 billion on China and 5.5 billion on the Western net, or is it 2 and 6? It's something like that. But I bet on the Western net, Brian. Just like because Google is a national asset, and Apple is a national asset, but all the application companies, they're all national assets. And if you got a bet between the market economy and decentralized capitalism and creative destruction, a la Schumpeter, or you bet on central planning economy, ultimately, you bet on the market economy because it's Darwinian. There's not a single educated person in the world that would have put a bunch of college dropouts in charge of the tech industry in the U.S. Bill Gates is a dropout. Mark Zuckerberg is a dropout. Larry Ellison is a dropout. Steve Jobs is a dropout. Michael Dell is a dropout. right? A lot of college dropouts with a lot of power, in the world. And normally centralized economies put people with PhDs and master's degrees from good universities in charge of stuff. And sometimes there's intelligent people from good universities, but a lot of times if they do the right thing, it's because they got beat up by dropouts or they got beat up by the market economy and they had their head handed to them because they got arrogant, and someone doing something that they disagreed with, blows up their beautiful model of the world, and they react, and the result is natural selection and evolution towards something better.
Yeah. Excellent analysis. Just final thoughts, Michael. I know you said a few months ago people should mortgage their house and buy Bitcoin. Do you still feel that way? And just final thoughts for people that have joined us for the last couple hours.
Look, to be clear, my view here is if you're in a monetary environment where the money supply is expanding at more than 15% a year, and you can borrow money at 2% interest or 3% interest, and you can buy something of tangible value that is not being debased or inflated away, it's probably a wise idea. If you buy a house and you pay 2.5% mortgage on the house, and if the house is going up in value 25% a year, the time to buy the house is not next year, it's last year, right? So, and the same is true if you borrowed money at 2.5% interest a year ago and bought the S&P index, it went up 37%. So the generic observation is when you can borrow money that is not marked to market for long durations for next to nothing, if you have a use of proceeds that you're confident in, then it's a good idea. Borrowing money at 2% interest to buy something that is going to go up in value, anything north of 5% is arbitrage. So I would say in general, it seems wise to me to hold tangible assets and let them appreciate in value as the money printer goes burr, and not pay off your mortgage. If you believe in Bitcoin, then yeah. If you have $1 million of Bitcoin and you sell it in order to pay off your mortgage, what you did is you gave up an asset that was going up 280% a year. And let's just say it's going up 20% a year. Let's be very conservative. Let's say it's going up 10% a year. You're selling the asset going up 10% a year in order to loan $1 million to the bank, and the bank is paying you 2.5% interest on it. And the Federal Reserve is going to increase the money supply by 20%. So it doesn't make sense to pay off your mortgage if you have one. You should be long debt. My general view on debt is you don't want to have short-term margin debt. Like, don't go and buy crypto assets or Bitcoin on 10-to-1 margin that's marked to market, because you might get forced liquidated in an afternoon and lose everything. But the most subsidized debt in the world is mortgage debt. The US government buys $40 billion worth of mortgage-backed securities every month, and they're keeping mortgage rates artificially low. And so if you're paying off your mortgage debt, you're basically holding cash. You're basically taking $1 million of stock, you're selling it to buy $1 million in cash, which the Federal Reserve is debasing and devaluing at 20% a year, 30% a year. And so the only way to get ahead of that is flip it, borrow $1 million at 2% a year, and then buy something which will hold its value. And as to what you buy, obviously I believe that Bitcoin is the apex property, but if you don't agree with me, study for 100 hours. If you still don't agree with me, study 1,000 hours. If you don't have time to study for 100 or 1,000 hours, then forget about Bitcoin. The next apex property is a piece of real estate that you're going to use for the rest of your life, right? And then the next apex property is a trophy asset that you think a wealthy person will want to buy off you in a decade. Ask yourself the question, what is it I can buy that someone with money and education will want to buy from me in a decade? And that gets you to a portfolio of high quality assets. That's why people buy high growth, buy a digital monopoly growing 25% a year. If I had to bet on Facebook or Apple or Google versus a value stock, I would bet on Facebook, Apple, and Google because they can ship a product to 1 billion people over the weekend for a nickel. And, I wouldn't buy a chain of, 20th century restaurants because they're not going to get 20x more efficient, So I think that's kind of common sense. And that's what I think about that. I think everybody should figure out what's their investment strategy or their saving strategy. And for your balance sheet, someone wants to give you debt. Not all debt is evil. If I loaned you $1 billion for 100 years at 0% interest, would you take it? Presumably, right?
Yeah.
Would it be irresponsible? Now, is it irresponsible to buy $1 billion of Bitcoin for 100 years at 0% interest? Well, if you think it's a good asset, no. If you don't know what it is, I think Warren Buffett said, if you're not willing to hold the thing for a decade, for 10 years, you shouldn't hold it for 10 minutes. Okay, so that's my view on that. If you don't want to hold the thing for a decade, then don't hold it for 10 minutes. But that's a separate question as to whether or not you take the $1 billion of debt for 0% interest for 100 years. I think when someone's ready to give you a $30 million loan, a 30-year loan for 2.5% interest, which is what the U.S. rate is right now, it's pretty much close to free money for the rest of your life for most people, depending on how old you are. And so the losers are people that can't borrow the money. Count yourself lucky you can borrow money for 30 years for 2.5% interest. The losers are people that can't borrow the money because they have to basically hold all their cash. Like, you don't have any assets, so you're making 100 grand a year, and this year it's worth 100 grand, and next year it's worth 80 grand, and next year it's worth 60 grand, and next year it's worth 40 grand, and next year it's worth, 30 grand, and I can run that, that is a Taylor series, some kind of series out for about 20 years until I get you to, it's worth nothing, right? So if you expect to live more than 10 years, if you discount it at 20% a year, simple math will illustrate to you that it's going to be worth nothing. So I'll end with my pithy quote, which is, the road to serfdom is working exponentially harder to earn a currency growing exponentially weaker.
And on that note, we'll let everyone digest everything we went through in the last couple hours. Michael, I really appreciate, first of all, you being a pioneer in this space. I mean, like you said, there's a reason not everyone's doing it because it's complicated. It takes a lot of thought. And I didn't realize all those methodical steps that you guys did last year to, educate the market on what you were doing, to get the right people to buy in, literally via shareholders, and then that exponential, takeoff. It's been a really important piece of the entire story. And, you've brought a lot of attention to Bitcoin and this concept of digital property. So again, I really appreciate you going out on a limb and doing that. And also just educating. These quadrants are a great way for people to really think about this stuff. And the truth is, you got a lot of people out there buying crypto who maybe have no business doing it and have no idea what they're doing. I've never seen so many newbie traders and volatility and panic and fear and pain on the back of it. So I think it's important that people think about that quadrant and think about actually what they're doing and what are you doing? It's not a video game. It's not Netflix. It's real money involved. So this is great. Your story is going to continue, and it's like watching a movie as well. So I appreciate what you're doing. The next 12 months, I'm sure, is going to be just as exciting. So thank you for the time, and thanks for putting your neck out there.
Until the next time, Brian.
All right, all the best. There he is, Michael Saylor. Follow him everywhere. The company MicroStrategy, another way that you can get in on the Bitcoin asset play. And appreciate you. We'll see you next time on London Real. Take care. DeFi, which stands for decentralized finance. This is a $9 trillion per year marketplace. I want to talk about our brand new DeFi Academy. Our first program is called the DeFi Accelerator, and we have been absolutely inundated with applications from around the world. I'm going to be talking about how you can profit from what I'm calling the greatest dislocation of wealth in human history. Decentralized finance is already revolutionizing the world of finance. You just don't know it yet. I'm going to talk about the difference between DeFi and cryptocurrencies. There's a big difference. I want to go into how to trade the markets. It takes a lot of discipline. It takes emotional discipline. It takes intelligence. It's not an easy thing to do. I'm looking for a small group of people who want to actively participate in this upcoming DeFi revolution. I'm looking for serious individuals only with real net worth who want to build this exciting financial infrastructure. I'm looking for partners, collaborators, investors, colleagues who want to join forces and create real value and generational wealth. If you're one of those people, go to londonreal.tv/DeFi and submit your application. Now you've got a chance. Life all comes down to a few moments. You have a chance now to join me on this incredible adventure for the next 10 years. It will change your life, the lives of your children and grandchildren, maybe the life of billions of people on this planet. What are you going to do? What's the choice that you're going to make?